So good afternoon, everybody. Welcome to this ACE webinar. So this afternoon, we're focusing on the bank finance schemes and the loans, government-backed loans available to you as businesses within the construction sector. What we've got as part of this is a slightly different format to some of our other webinars. So we are going to start with an overview of the support available, just to recap to everybody exactly what you can access and what's now on offer, particularly because it's been changing quite frequently. So we'll give you that overview, and then we will come to sort of a bit of a Q&A with Geoffrey Spence, who I'll introduce in a minute. He's our guest on the webinar today, and then finally there's going to be some Q&A at the end, so you do have the opportunity to ask questions. If we can just move on to the sort of housekeeping slide next. So for those of you in attendance today, we've got, if you haven't been on one of these before, you're very welcome. This is run by ACE, but it's open to anybody across the whole sector. If you haven't been on one of our webinars before, just to note that you can ask questions on the panel on the right-hand side. So you just type your question in. You can do that at any point during the webinar. And what we will do is collate those up, and when we come to the Q&A at the end, in between myself and Geoffrey, we will do our best to answer your questions. If we don't get through them all, we will send answers afterwards. The other point to note just before we get started properly is that actually we're going to be recording this webinar. So if you've enjoyed it and you want to watch it again, or if you'd like to share it with some of your colleagues and perhaps some of your supply chain, we do put all of the webinars recorded up on our website. So again, you're able to listen back and share this. You can find them on our website at the bottom there. We will also circulate the link afterwards. Okay, so just before we introduce Geoffrey, I will just outline and recap the loan products available to you. So essentially, this is something that the government has brought in, whereby they are working to guarantee a certain level of finance for the banks to be able to offer it. So although it's a government-backed scheme, it's actually administered through the individual banks. So what I'll do is I'll give you an outline of the schemes on offer, and the way that you would access them, and the detailed terms and the detailed application forms and things is something that you would pick up directly with your own banks. But just to give you a feel for what's on offer. So the newest product that has been announced and developed between the government and the banks is these bounce-back loans. So this was actually only announced on Monday this week, and this was really aimed at the very, very smaller end of the market. It's aimed at businesses that really are wanting to sort of access a very short-term kind of cash flow boost, if you like, of up to £50,000. But what in doing that, this is, the banks are able to offer this in a very simplified application process. So this is open to businesses that are interested in sort of a very small amount of borrowing. It's quite slick in terms of, you get the money quickly, the applications appear to be a lot simpler than the others, and you still have some of the benefits of the government-backed products in terms of having the 12 months interest-free. So that's just been launched this week. The other scheme, which has been around for a little bit longer, for a number of weeks, is the Business Interruption Loan Scheme. So this one is again administered through the banks. It is a government-backed scheme, so the government do guarantee sort of the value of the loan and the security of the loan to the banks, which should mean that they're in a position to offer you more favourable terms. Now that is down to the bank's discretion, because the government doesn't actually dictate terms on these products. What they do is they give that surety to the bank, and then the bank can interpret it and take their own view on the lending risk. What you've got here with this sort of small businesses, it gives you the next kind of category, or the next funding band, if you like. So you can borrow up to sort of £5 million on this. There are different levels. Obviously, you don't have to. You can shape it however you like. It's for that conversation with yourself and your bank around what you actually need, and they're available for sort of up to 6 years in terms of the payment periods. So some of the changes that have been announced recently to this scheme, because it's been quite contentious in terms of how it's been set up and how the banks have interpreted it. So, for example, it started off where the banks were wanting guarantees secured against people's properties, which was very controversial. That's now been agreed that they won't be seeking personal guarantees on loans up to 250,000. So that will help, you know, certain SMEs and things who want a loan below that. And the other change was that actually this has now been opened up in terms of the ceiling threshold on the businesses that are eligible for it. So before, this again was very much targeted at the sort of SME community, small businesses. What's happened now is that this has been opened up so that you can have businesses of up to sort of turnover of up to 500 million within this. So again, that is something which I think is still slightly controversial. So you know, there is it's going to be a statement out later today through the Construction Leadership Council, just commenting on how slick or unslick, shall we say, the application process is, and maybe the risk appetites, and how the banks are approaching this scheme, because it's not as smooth as you might like it to be, particularly if you're targeting smaller businesses who don't have in-house finance directors who are used to dealing with this. So there's a little bit of work to be done there around the application process on this scheme, but we think the eligibility now is much better in terms of things like the guarantees. Okay. So just on to the last two products available. Now this is very much at the sort of larger end of the market, so bigger businesses. There was a bit of change in this space since the products were launched. So this is the latest information. So originally it was just the corporate financing facility launched, which is the bottom product here, which was quite challenging for the construction sector because it required you to be investment grade. It required you to have quite a lot of sort of sureties and gearing that we don't typically have in large construction companies. So it was effectively might have been helpful to the kind of wider you know, economy in terms of large businesses, but was very, very challenging as a product for any of our large firms to be able to access. So through a process of feeding that back and a bit of lobbying across not just the construction sector, but other sectors, manufacturing is similar as well. We were actually able to secure this new scheme, which is the Coronavirus Large Business Interruption Loan Scheme, which is based on the scheme that you saw on the last page for SMEs, but actually just increasing the the sort of annual turnover there. So we're still waiting to see, because this is quite a new one, we're still waiting to see how many of the big firms are able to make it through the process here. So there's a little bit of an unknown, but generally this is, it should be simpler. You've got firms there interfacing with it that have finance directors that understand the sorts of applications and forecasting that you need to do to get through this process. And as far as we understand it, it now means that large construction businesses are eligible for some level of government-backed support, which wasn't the case with the corporate financing facility below. So that's a bit of a summary. That's sort of a slight whistle-stop tour. I wasn't going to go through I'm not able to go through a lot of detail in terms of terms, in terms of rates and fees and things, because actually all of that is based on your conversation with your bank. So they are government-backed schemes, but it is down to the individual banks to actually, determine, to assess your credit worthiness, to assess your business plan, to assess whether you're a viable business, and then they will make offers, to individual businesses based on that. So they'll make lending offers based on that. Aligned to that and similar, but if we were just talking there about sort of finance and loans that you could access through the banks, there are some direct grants available, albeit not as widespread to the construction sector as to other sectors. So hospitality, for example, have got a lot of direct government support. We have less, in part because the government's view is that we should be able to try to continue working, and it's not where there's sort of a government edict as there is in hospitality, where they just physically cannot work, they can't operate. So there are some grants available. I think actually the grants in the devolved nations are more generous. So if you're Wales, Scotland, Northern Ireland, you will potentially be able to access more grant support than you can currently get in England, where it's a bit tighter on the rules and things. So it's worth looking at that. And when I bring Geoffrey in a minute, we're going to have a conversation about how do you weigh up all of these options, and when do you decide that actually you should be going for a sort of finance option versus some of the others, which are either grants like this or other ways to help your cash flow, such as the furlough scheme, the job retention scheme, and some of the deferrals on the VAT as well. So I think in terms of covering, giving an overview, I hope that's been helpful. We have all of this obviously on our website as well. There's some quite good, business support websites that the government's finally put up. They didn't have this to start with, but actually, there's sort of, in terms of accessing the support and understanding exactly what's applicable to you wherever you are in the UK. You can see there's now a raft of websites you can access, but we do keep everything, and we do put a sort of consultancy and construction sector lens on everything that goes on the ACU website. So again, please do keep looking on there, because we keep that very, very live. I think that was everything I wanted to cover in terms of just giving an overview, but like I said, we've got plenty of time for questions. So if there are specifics or specific points of feedback that you want to bring into the discussion on the webinar, then please do that. You can do it at any point, and then we can come back to them. We'll have time for Q&A shortly. But as you might have gathered from that overview, I am not an expert in bank financing. I am not an expert in company financing, but we do have one with us. So I'm really pleased to introduce Geoffrey Spence. So a little bit of insider knowledge. Geoffrey used to be my boss in Infrastructure UK in the Treasury, but actually the reason we have Geoffrey is because he's got a fantastic experience of working not just in central government. So he was sort of SPAD advisor to Alistair Darling during the last financial crisis. So he did a lot of sort of central government advice there, understands how government would be approaching these. But actually, he's also very knowledgeable on our sector. So he was the chief exec of Infrastructure UK, established things like the UK Guarantee Scheme, understands really our markets. And then more recently, he had a position in Lloyds Bank as well. So I think I've probably bigged Geoffrey up enough. Just to say that, please do make the most of having Geoffrey with us today. I'm going to sort of do a bit of an interview with Geoffrey now, just to draw out some of his thoughts, some of his kind of insights. And then what we'll be able to do is to put your questions to, I say, probably more to Geoffrey than myself, but I will try and help as much as I can from my position. To keep those coming through. I can see we've already got some landing, so that's brilliant. But Geoffrey, lovely to have you on the call.
Thank you, glad to be here.
Right, so this is it. In the manner of a virtual interview, I shall get started. So, as I mentioned in the introduction, you were actively involved in the last major crisis society faced. Now, obviously, no blame there, no insinuation, Geoffrey. But you were at the centre of government during the financial crisis in 2008. So, could you give us a bit of an overview of what went through the government's mind, how they responded to that? And the sorts of, the approach that was taken then, so that we can maybe overlay that on what's happening now when we come to compare.
Well, every government and senior leader in the government has got their own personal experience and personality, which actually comes to bear very directly in crises like this. And if you were a Labour government in 10 years ago, your real concern, and that certainly was a voiced concern of the Prime Minister and the Chancellor at that time, Gordon Brown, Alistair Darling, was they didn't want to be labelled alongside Philip Snowden, who led and was Chancellor in a Labour government in 29-31, which saw a slump and a mass unemployment. So, I mean, I think probably where this government is coming from at the moment, given the severity of the crisis, is to preserve as far as possible employment and therefore the economy through the particular crisis that we all face. And governments have different ways of doing that, but they have different tools, and they've got to do something in the real world to help and to stabilize the situation. And then the other thing they've got to do at the same time is to communicate that effectively to the various parties concerned. By that I mean business, the wider community and obviously the press. So there's almost two battles are fought during these crises. One is tackling the real world, and then actually tackling the comms world.
No, it's really interesting. I think it's quite easy to, to see government as a sort of inanimate object, really, rather than actually recognising these are people, and they're having to make some really quite difficult decisions when they don't really, nobody really knows quite how this is going to unravel. So, okay.
Yeah. So I think if you're a government in this situation, you've got big tools to fix things, and then you've got very specific, more targeted, maybe more limited tools. So let's just go back a little bit into the history and say, what did the last government do to help? Well, the biggest thing it did was to stimulate the economy by cutting VAT, and then actually raising it at a later date to bring expenditure forward. And then the second biggest thing it did was actually cut interest rates and experiment with QE. And then the third thing was actually restore the banking solvency, and that, if you remember, was equity recap, lending to banks, and also having a scheme that actually compensated banks for bad loans that they'd made. And I think the problem you've got at the moment is when you look at all those things, which are the big tools that a government normally has, actually they're not very effective at the moment. I mean, if there's no demand because you shut down the economy, cutting VAT doesn't help much. Interest rates were already at a very low level, so actually cutting interest rates doesn't help much. And while we may go from this crisis into a financial crisis and then a sovereign crisis again later on, actually there's no need to restore the banking solvency and liquidity because they actually are well capitalized coming into this crisis, certainly compared to the last time. So I think that the interesting thing about this situation from the government's point of view is, I mean, they're having to find tools to intervene that actually are new, as well as some old tools, largely because it's such a different form of crisis.
No, I think it's interesting. It is, yeah. It's obviously from the industry perspective, it's quite hard to recognise that. You don't see it because you don't know it because you're not in it. In the same way, I think they find it difficult to put themselves in the shoes of businesses and design policy that's completely effective. So, I mean, just one of the challenges and one of the sort of feedback that we're getting, certainly from our members, is the balance between offering finance, offering loans or government-backed loans versus offering grants. Now, it's I just wonder your thoughts on how what do you think the government's think of the government's approach at the moment, whereby we've just recapped, actually there's a lot more available to us in the construction sector in terms of loans than there is in terms of grants, which seem to be being reserved for other sectors.
So I think the way, look, the first thing is this crisis has come very quickly. I mean, it hasn't given much time for the government to respond in an appropriate way. And often the real problem that government has in responding to these crises is finding delivery mechanisms that work. So the political will can be there, but actually finding something that delivers to a population of over 60 million people and all the businesses that entails is actually really difficult for government. Because they're relying often on third parties. So in the case of loan interventions of the sort we're going to talk about in a bit more detail, I mean, they're really relying on the banks. Now, in the past crisis, of course, the banks had a problem themselves, didn't have enough capital to lend, and also couldn't borrow enough to actually lend on to lenders. So a lot of interventions had to be geared here for that. I mean, here, the scheme they initially set up, which they did quite quickly, was to use an existing scheme and expand it. I mean, this scheme was used in the last crisis. It's been around for quite a while, and what they've done is just expand it, make it more wide, and try to make it more generous. But one of the conditions they originally set down, which is where I think quite a few of the problems have been, particularly the smaller businesses that have applied for it, is they basically said to the banks as part of the scheme that this should only be used if all other sources of finance have actually proved to be unavailable to the borrower. So a lot of the problems have arisen in the early days because, there's two aspects to that. One, the banks did have to ask and consider personal guarantees because obviously in a normal environment, that was an alternative source of finance, and they had to prove under the scheme that that wasn't available or wasn't possible to actually get access to the loan scheme. And I think the second problem with that arrangement was that, of course, from the bank's point of view, they still had exposure to lend. And I think the difficulty was that, if the principle is there's no other way of financing this, and that can only be because the business is in so much trouble, it's probably the last thing as a bank you want to do, to lend that extra 20% and take that exposure on. So I think institutionally, it was a very difficult thing to actually wheel out in any volume, and that, of course, is what has proven to be the case. Now, unsurprisingly, that was a quick intervention by government, and I think you can always anticipate they will refine the terms as time goes on, as they get feedback, to try and adapt the scheme to achieve their purpose. Now, I don't think their purpose will be to save every business in this country, but their purpose will be to provide liquidity rather than solvency through these guarantee schemes for companies that have got a future but need liquidity, and to enable them to access more of that from their banking relationships than the bank in a prudent way would want to give at this point on its own. So you still probably have to prove that it's liquidity that you're looking for rather than solvency to make it really work for everyone. And what you get from these schemes is more by way of value of loan finance with some preferential terms than you otherwise could get. So with these particular types of intervention, loan interventions, I mean, what you're doing is providing some relief for companies that will, in all likelihood, survive in the future. You're not actually providing, and you're not probably intending to provide, what I would, a slightly more sort of aggressive form of intervention, which could be regarded as bailout finance. And I think the government's view on that, from the way they're, for example, approaching the airline industry, where, for example, with Virgin, they're very reluctant to provide support, is when it comes to that type of support, they want to probably, in most cases, do that bilaterally and on a negotiated basis, if at all. So I draw a distinction between providing liquidity and providing solvency, and the loan schemes are really about providing liquidity. I think, however, we have to recognise that the second big block of schemes they came up with, which is huge, both in terms of scale and also in terms of significance, is the furlough scheme. Certainly, any other organisations I'm involved with, I'm really encouraging them to aggressively take advantage of this scheme. And why does this work? And actually, you don't hear very many complaints about it. Why does this work better? And one of the reasons is the delivery mechanism. I mean, always look at the delivery mechanism to work out how you're going to manage these different sort of schemes. This delivery mechanism is directly under government control. It's HMRC, who actually has access and the scale to implement it in line with ministers' preference. And that's one of the reasons why it actually is very generous, both in terms of the amount of money that's been made available and also its openness to quite a wide range of institutions, largely because they find the delivery mechanism that works. I mean, other countries have got these schemes. They've had them for years. And finally, and we looked at it in the last crisis as doing a scheme like this, but we struggled to find a delivery mechanism that worked. So I think some credit has to go to the government in terms of the furlough scheme for actually making it work in broad terms, making it widely available. It's costing a fortune for the state to actually fund it, and it's really designed to achieve that overall objective that I think is at the back of their minds, which is preserving jobs as long as possible until businesses have had a time to recover, not to bail out businesses, but to protect employees within those businesses. And I think we should look at these schemes side by side, because that's a huge grant and the most important grant. And it really, it also will help solvency, not just liquidity, although it will also help liquidity, largely because it's grant rather than loan. So I think it's important to look at the two of them together, and in dealing and working out which is likely to be beneficial, always look at the delivery mechanism and don't expect the delivery mechanism to necessarily behave much differently from the way it would normally behave. I don't think banks will behave fundamentally different. in their engagement on this, but this is a help to making that relationship better, deeper, if you're still viable and the bank thinks you are. And the furlough scheme is there really to actually boost solvency for the long term.
No, thank you very much, Geoffrey. I mean, that was very comprehensive, and actually a level of insight which you probably only get if you can see both sides or have been on both sides of the table. So really appreciate that. Maybe a sort of a slight follow-on. You mentioned there's a whole raft of schemes available. I just wondered for those sort of business leaders thinking about how do I go about this? Do I, for example, furlough employees and then look to secure the finance if I need it, such that I think that there's going to be an order book coming in 3, 6, 12 months time, or actually do I sort of bite the bullet now and make a fundamental decision about the size of my business and what an effective business in my position will look like in 12 months time, when there's an awful lot of uncertainty. So I mean, maybe just to narrow that down to a question, if you were in the shoes of leading some of these businesses in the construction sector, what would you be asking yourself to ensure that you were, for example, making the right approach to the bank for the right reasons? Because there's quite a lot you need to think about, as you've just outlined, in terms of navigating to really what you should be aiming for as a business.
Yeah, and I think each business is different. I mean, if you've got a public sector stream of revenue, I mean, if you're selling either directly or indirectly, and of course in infrastructure it can be indirectly, into a public sector revenue stream, I mean, I think will continue to be quite a secure business in terms of its market. I mean, obviously if you're a retail business, you're in a different world completely, because frankly, it seems apparent that there isn't going to be the same retail world at the end of this that there was at the beginning, although that just seems to be accelerating an existing trend to move online. But if you're in construction infrastructure business, I think one consideration is who your client base is and what your market's likely to be, and a judgment as to whether that means you've got a liquidity set of issues to face, or if you're completely at risk to a property, private development property type business stream, then obviously you've got to say, well, that does look far more at risk in this scenario. So therefore, I may have to assume that my business is going to be lower. I don't think there's any way of avoiding, of trying, and indeed in discussing with banks, of actually showing that what you think is likely to happen, even in the circumstances where there's not visibility, but actually having some ability to say, look, in a number of different scenarios, here's what we think the future holds, to the extent that we know at the moment. So I think you have to do that. I think if you're talking to banks, I mean, look, there's one very basic thing: don't shout at them. I mean, this sounds sort of a bit obvious, but I do have come across, particularly on the small business side, because of the frustrations of the situation that both are in, it can descend into a shouting match, and it's really not advisable. As far as possible, retain constructive engagement with the bank that you've got, that knows you well, and can actually share your judgment about the future. And however frustrating they are, they're driven by their own institutional imperatives, and you just have to find a way of working with that. As far as possible, come to terms with what the future looks like. I think obviously with the furlough scheme, you don't really have to make a judgment about your staffing level for some time until there's greater clarity, because the government's going to pay 80% of those costs, possibly 100% if you're furloughing people out at 80%. And the whole aim of that is to give you time to wait for visibility before making those big decisions. And although some companies obviously are already making those decisions, like British Airways and their recent announcement, I think the furlough scheme does give you time to sort of to wait to see what happens. Now, I mean, my view is that construction may come back earlier than other sectors. I think it already is in some places. I think the government will want to achieve that, if it can, to actually have construction taken forward on a safe basis in terms of social distancing. I think a key approach for those businesses on the front line of infrastructure is to deliver a way of doing that but also those in support of that front line have to come up with a plan that enables them to deliver, for the medium term, a business that can actually comply with the social distancing measures that are likely to be there for, possibly a year, possibly longer, depending on where the clinicians end up on this. So it's a bit simplistic, but have a constructive relationship with your banks. You have to think about what the future might hold. You have to sort of try and work out what that could look like under different scenarios. But you do have some time in terms of choosing, what size of employment base you can retain because of the furlough scheme, and take advantage of that to the full.
That's brilliant. That's very helpful, pragmatic advice for us, which is that you don't always get when there's a lot of technical guidance. It's a bit more actually, insight there. So no, really appreciate that one. Thank you, Geoffrey. A sort of follow-up question along those lines, and something which I know now businesses are starting to turn their minds to. As you say, they're taking advantage of the furlough scheme. They're looking at the pipeline, and something that's been raised is the almost the ability of new projects to pick up. If you're on site, like you say, as long as you're, we can remobilise and get back working within the Public Health England guidelines. That's one thing. I think there is perhaps it's worth just drawing you a little bit on, what are the options to kind of recapitalise the industry if we want to get going with new projects, recognising that although we've got things like the furlough scheme, actually there could be, real sort of squeeze on sort of, cash flow within the industry, capitalisation, or ability to be able to access finance, where you've got perhaps the developers and the contractors working at much lower productivity levels, which is eating away at what capital they did have. So what I know you were very instrumental in the UK guarantee scheme. So what options are there sort of specifically within construction if we're going to need to refinance, recapitalise certain parts of the industry just to get started with new schemes?
Yeah, so look, I would be concerned about where we are in the future with what I'll call the tier 1 major contractors. Because I think they were reasonably battered before this happened. And what I mean by that is obviously some of them had financial difficulties, and Grillian, of course, got into severe financial difficulties. I think all of that led to gearing issues in the sense that they're quite heavily geared. And the core of it all is they were not earning enough money by way of margin. Really to be, to really sort of function as really strong corporates in this sector. So for me, I don't particularly have an answer to that, I'm afraid. But I would, if I was sitting in government, I'd be saying, is this an opportunity to do something that actually enables us to transition into, corporate contractors, larger corporate contractors with significant balance sheets and liquidity to actually carry the infrastructure plans forward, which I think the government will retain at the end of this crisis, and would be willing to finance. So for me, what I would be saying in one part of the industry is, look, it's important that we come out of this with a stronger set of lead contractors. We're definitely going to have far more of a government direction on industrial strategy going forward. We need to have an industrial strategy now, and we need to be thinking about it now amongst all of this other crisis. How are we going to bring these companies into a position where they're going to be strong with sufficient competition, but not too much competition in the industry, to enable us to deliver our infrastructure plans and actually therefore support second-tier suppliers and others in doing this business. And that's a really bilateral set of engagements by the government, it's a bit, and actually quite a difficult set of discussions with the industry, but I think they have to be had. If that means mergers, if whatever else that may mean, I think there's going to be a need, maybe in the second half of the year, to be more proactive in reshaping this industry.
No, I think that's, yeah, and I think you're absolutely right. And that's certainly, we're seeing some of that tension play out in some of the recovery planning that's happening at the moment, and the conversations there around actually how far do we want to go in recovery planning to recover the industry that we've got now? Or is this an opportunity to reset it to the industry that we want in the future? So be interesting to see. I think we're just scratching the surface on that, if I'm honest, in terms of recovery planning. But as you say, this could be a huge opportunity to actually start to shift the modus operandi of the industry, so that we are structured differently, rewarded differently, and perhaps more sustainable, more resilient going forward.
Yeah, look, I think here's the politics of this. I mean, everyone's on the government at the moment for PPE and the shortage of PPE. They're on the government for care homes, what they're doing about this. So everything's focused still on how do we get out of lockdown in terms of just getting out of the house and of dealing with the clinical problems of COVID. I mean, these agendas move quick, and very quickly, the real political focus will suddenly come on the government on recover far more directly on what are you doing to recover the economy. It sort of switches quite quickly. So I think the government in quite a reasonably short period of time, I mean, their priority is going to have to shift. They'll still have those clinical priorities that are really important and should be sustained, but the political pressure will come on these sorts of issues. You're already beginning to see it in terms of what's the plan for getting out of lockdown. Well, actually, who cares about the plan? Let's make sure we can move out of lockdown in a safe way, and then it's the economy will come to predominate in terms of the political discussion. So for the construction industry, and indeed for the consultants, it really is a good idea to think about how can I play into that political discussion to get what I think is right for the industry. And I know that's something that ACE is thinking about, and indeed others are. But I think we've got to come out of this crisis with something better by way of an industry. Because I don't actually think what we had before is going to prove to be sustainable, and I think people are right to say this is a completely new world we're entering into post COVID.
Interesting times, and then, as you say, it's definitely something that we're very actively looking at. I think is, if we want to steal a phrase from Boris, which I don't often do, but we have got some pretty good oven-ready ideas on that. So, as you say, this is perhaps the time to start bringing those out and seeking to have serious conversations with the Treasury and the Cabinet Office about them. So, definitely something that we've got going on in the background. So, just to close out, I want to monopolise all of your time with my questions. One final question from me, and then I see we've got a few coming in that I'll ask you from the audience. But if we're taking a look at the next 3 months, the next 6 months, you have the benefit, I think, of having that insider knowledge, but being one step removed from the politics and the emotions of the situation. So what would your one piece of advice be to the government around how they manage this over the next kind of 6 to 12 months? What do you think that they're perhaps missing at the moment or could do more of?
So we have a big debate about. I mean, I think my one general comment is I don't think we've come into this crisis prepared for it, and there's lots of different ways that's the case. I actually think in the economic case it's true as well. This is probably not for the next 3 or 6 months, but I think I mean some of these particular problems these loan schemes shows that. I mean, and the fact we've probably had 3 crises in 10 years. Whatever you think about Brexit certainly presented a bit of a crisis for some. We had the financial crisis before this, now we've got this. I mean, I think we're living in a different world where actually it's more uncertain, and we have to build capability institutions that can actually see us through troubled times on the expectation that we're going to have more trouble more regularly than we thought we did maybe about 15 years ago. I think the scale of this at the end of the day, this is a very big event for the UK in terms of the damage it's going to cause. And I think we should think about it as what are we going to build coming out of this war? And in Germany, what they built was a series of institutions after the last war that supported business very directly, institutionally, with something like KfW that was separate from the civil service to a degree, but accountable within the public space. And I do think, you know, we do have to, one of the things we've got to do is build new institutions, a bit like KfW, which very directly supports small business going forward at the same time as actually developing a serious industrial strategy. So that's one thing I would say, but that's probably for the long term. In the short term, look, they are responding quickly. You know, in government terms, what they have to do to get these schemes off the ground, they are doing phenomenally quickly, what normally would take far longer. So I think speed is good, and I think they will adapt any schemes to sort of try and meet some of the criticisms that they face. We've seen that already, and they'll continue to do it. They've got to decide carefully what they do about the furlough scheme. That's probably the most important scheme for jobs, as to how they wind that down, and they are going to have to wind it down, and when, and do they do it by sector? So that's the big decision for them. I think over the next few months, after they've made the bigger decision of how they bring, you know, how they restore some of the economy's effectiveness from lockdown, which of course is probably the most important thing they could do. You know, apart from that, I wouldn't bother with any more schemes. I would just focus on getting the ones they've got out right, and then they've got to decide what they want to do on a fiscal side. Are they going to provide it when demand comes back? Are they going to seek a way of stimulating that by a further fiscal stimulus? I think they're going to have to. So is that a VAT cut? Or what is it to get people back? I mean, if you look at the airlines, I know people like Ryanair are thinking about, if they're going to get people flying again, they're going to have to reduce their fares to really low levels to get people used to flying. Well, in the same way, I think the government is going to have to think of some fiscal measures, partly because monetary measures don't work very well at the moment, to get people spending again after actually being quite scared. So I think a fiscal stimulus is probably the next thing people have got to think about. And then ultimately, of course, there has to be sensible decisions made in the long term as to how the bills that have arisen from all this are actually going to be paid. You know, because clearly there's going to be a big debate. Are we going to have another period of austerity? Or are we just going to have another period where taxes are higher to pay for the colossal amounts of money that will have been expended over this period to support the economy?
I think that, you know, sort of uplift on taxes has been hinted at, hasn't it? So perhaps that's something on the horizon that we need to be aware of. Okay, brilliant. Right, so I'm going to go to some questions from the floor because I have totally monopolised your time. So we've got a question for you on inflation. So Geoffrey, you talk about government's use of quantitative easing and control of interest rates. What is the future of central bank independence and targeting the targeting of inflation as the rudder for the economy? Discuss.
So the thing about Bank of England independence is not completely understood, because, for example, the Bank of England do not set their own objectives. Government sets the Bank of England objectives and can amend what those objectives are at any time. So, for example, they set the inflation objective, and then they hand over, if you like, they delegate to the bank to implement that in terms of their policies, such as you know, the setting of interest rates through the Monetary Policy Committee, or actually controls on banking through there's the Financial Committee as well, mirrors the Monetary Policy Committee. So the first thing is that the government can set the bank's objectives, and they've set an inflation target which has been quite consistent over the time. I mean, inflation has been really hard to, you know, short of oil prices moving in a very adverse direction on occasions. It's been quite hard to do anything that actually gets inflation up. And obviously with this huge global shock to demand, I don't actually think that there will be huge concern at this point on policymakers' side about the future of inflation getting out of control. And they certainly will think that if there's any pressure on that, they've got other measures they can introduce to stop it or to limit damage. And I think they'll be far more worried about deflation, which creates far more problems. So I actually don't think, I think, you know, obviously that's broad inflation. There may be particular shortages and blockages on supply that lead to specific problems on particular items of inflation. But I don't think, if you like, macroeconomic policy will be driven by a worry about inflation. I think it'll be the opposite. I think they'll worry about deflation, and therefore on interest rates and quantitative easing, that's the thrust they'll have, which is to support the economy.
Okay, brilliant, thank you. So just a question on the business interruption loan scheme. So this is the job retention scheme, as it's also called. It's thinking about how you might use that alongside some of the other measures. And as you say, you know, you were sort of encouraging firms to take advantage of that, or saying that you thought it was, you know, quite a positive thing in terms of job retention, and people should be using it. Now I've certainly noticed in the guidance and the steer from the government, the position on when you should use it has definitely softened from when it was first launched. There was quite a sort of, you know, you should use this only where you're looking at, you know, the alternative is to making your staff redundant. Whereas now it seems to be a little bit more relaxed insofar as, you know, try to use this to keep people in employed. Try to use this ahead of a problem, so that you don't sort of, you know, come to the crunch and actually have to make people redundant. I just wondered what your thoughts were on that, and actually how, you know, how that might be policed, how that might be looked into by HMRC, where we've had the sort of change very much in the messaging around when you should use that type of scheme. I think there's some nervousness of firms to take advantage of it because they're not quite sure on the rules of the game.
Yeah, so I mean, when I was in the Treasury, we used to devise quite a few schemes to support business. I have to say, I always, you know, and sometimes I said that some of them were clearly designed never to be used because they had conditions and so forth that basically made it look as though there was quite a lot of support available, and then made sure that there wasn't a lot of money spent. To be so slightly cynical point of view, I mean, there are other schemes that certainly during the last crisis that we put in place. And I do remember, you know, having to say to people, look, this is one of these schemes that's been designed to be used. In other words, it doesn't have the same inflexibilities. When I look at the furlough scheme, this is a scheme that's been designed to be used. And although, you know, HMRC is involved, and that could cause quite a lot of concern on some parts, that's really because they're the people who've got the infrastructure to do it, and they know about who's employed where through the PAYE system. So they've actually got a capability which actually helps to detect fraud, because clearly, actually, the way this is designed, there is more options for fraud than some of the other schemes that you can see, particularly the loan schemes. And there's certainly a lot of opportunity to use it in circumstances where you would probably have paid the employees anyway. But the way they've done it, without really, I mean, it's quite a complicated calculation you've got to make in accordance with their formulas as to, you know, how the payment should be calculated. They've really left this with far less sort of conditionality than I would have expected, and they've really designed it to be used, and they're not tightening it up as yet. I think that might change at a later stage in this crisis. But I, at the moment, wouldn't have any reservations about using it, because I think the government wants you to use it, and therefore, you know, it's I wouldn't be. I don't actually think that issue about you've got to approve. You don't really have to prove you're going to make anyone redundant. I think that was just a general comment initially, and as you've rightly said, I don't think there's any real conditionality that you have to prove that you would have made them redundant.
No, I think, again, that's a really helpful insight, I'm sure, for the businesses who are not wanting to be on the wrong side of the rules, but perhaps because of the pace at which these schemes and the policies are being announced, it's quite difficult to really, you know, unpick exactly what you were able to do, what you're not able to do. So I think that's a really useful steer for them. So it's a question coming on recovery. So I think wanting to draw on your experience of perhaps planning the recovery and restarting the economy after the last crisis, albeit different set of circumstances here. But it's a question specifically about what might be on the government's mind as levers they could pull during the recovery. So you've mentioned the possibility of a fiscal stimulus, and specifically, if we look back to the budget just a few weeks ago, there was a lot made of infrastructure and an infrastructure revolution. Now, given the whole world has changed in the last few weeks, I think how do you think the government will be viewing that now as part of a sort of economic stimulus going forward? So both, sort of the infrastructure that was promised, but also perhaps kind of the house building as well. I don't know what your thoughts are on that, Geoffrey.
Well, I think I think politically it's very difficult for the government to walk away from that after this is over. You can't have a crisis like this and a struggling economy and said, right, it's time to ditch our infrastructure commitment. That obviously presents a challenge to them because they will not have as much money to spend on it unless they completely change their approach to their fiscal policies, which they might. And I think the second problem is I think they've got to find a short-term stimulus. I mean, infrastructure is great, it's important for the economy, but it's really hard to get a short-term stimulus out of infrastructure for the economy as a whole. The only thing you can do is fill potholes or something like that, which gives us a short-term hit. You can't build a Crossrail or anything like it to actually deal with a short-term sort of economic, to give the economy a short-term fillip. You've got to go to the tax system to do that. And obviously they're going to want to spend more money than they've said they have to date on the healthcare system. So they're going to have a crowded set of agendas they're going to have to sort as to what they want to make as their priorities. If I had to guess, I think we'll be paying more tax to pay for all of this. I think they will introduce a short-term stimulus, and I think they've got to keep with their infrastructure plan, but whether it's to quite the same schedule. And then the big question for me is, oh well, in these circumstances, should they think about maybe some different ways of financing some of these infrastructure pieces in a time of sort of concern? They might come back with a thought about, oh, maybe we have to go back to thinking about private infrastructure. I'm sure they're not going to think about that over the next few months, but year or 2 years from now, I could see that possibly coming back onto the agenda in a way it hasn't been over the last couple of years. But I think they will keep the infrastructure commitment largely intact, but the timing of it and also the delivery mechanisms, I think that's the thing they may look at again.
No, that's again really, really helpful. And as you say, we never really got to the end of the infrastructure finance review. So that was a sort of ongoing when all of this kicked off. So so perhaps that's something to look out for, or maybe something that will come back to life. Because as you say, there is a huge need to perhaps unlock some of that private finance to help. Where we're just not going to have the public sector funding that we may have, or the government may have thought that they had at their disposal when they made some of those big infrastructure commitments. So brilliant. Okay, now that's really helpful. Right, I'm going to start to just draw to a close now because we've only got a few minutes left. We haven't quite got through everybody's questions, but we will follow up and send you responses via email. So thank you very much to everybody who has answered, who's asked those questions. Thank you very much to Geoffrey for taking the time to speak to us today. I found that hugely helpful. I think probably perhaps our best webinar in terms of advice and just that insight, the depth of insight beyond perhaps what we could pick up and read in the government guidance. Just to thank you, James, my comms chap, for putting this rather large picture of my head in the slide deck. Just to say that this is obviously, we have these webinars, we have experts such as Geoffrey joining us. We also have an ongoing Ask ACE, so we know there's a lot of stuff that's changed around how you're running your business, questions around your market. So there is an opportunity just to fire questions into us. We're trying to turn this around very quickly, so please do keep sending them in. Don't be worrying or concerned or thinking on your own, so please send those in. And just to conclude really, so this is one of a series of webinars that we're running. So obviously business loans and finance we've done today. Next week we're talking very specifically about tax credits, and again there's some interesting things in there which you may not immediately think of in terms of a mechanism to help your business recover, but could be quite beneficial when you think about your strategy, and perhaps in light of what Geoffrey was saying about, you know, what's the industry that we want, how can you really utilise that during this time. And lastly, what does recovery look like? We hope by the 12th of May we'll have a bit more of a steer in terms of the government's plans, and we're on that call we'll be joined by Andy Mitchell, the chair of the Construction Leadership Council, just to discuss through how he sees the sectors evolving, and perhaps what's on their agenda for the next 12 to 18 months in the conversations they're having with government. So I think that's it. Thank you very much for joining us. As I said before, you'll be able to access this recorded online. Thank you again, Geoffrey, for taking the time. A man very much, I should imagine, in demand, given your experience at the moment. So really, really appreciate you joining us today. And thanks to everybody who dialed in and who asked the questions. I hope you have a lovely rest of your day, and take care. Thanks all. Bye.